Welcome to TalkTickers. We're the ones who cut through the noise of earnings calls so you don't have to. Today, we're doing a real deep dive into Entra ASA's latest results, Q2 FY25. Now, if you're not familiar, Entra is a really major player in Norway's prime office market. They own, develop, manage some key properties there. Our mission, like always, is to pull out the most important bits of knowledge, the insights, give you that shortcut to being well informed on this update. We want you to get a solid understanding of how Entra's doing, what it means for the market, without feeling totally overwhelmed. And just looking at the initial reaction, the market seems pretty positive on this report. Seems solid.
It really does seem solid, yeah. Let's jump into the headline numbers for Q2 FY25 first. Rental income landed at NOK 770 million. That was admittedly just a tiny bit below the consensus, which was NOK 775 million. And this is the interesting part, their cash EPS really delivered. It hit NOK 1.91. That actually beat the street view of NOK 1.85. So yeah, slight miss on revenue maybe, but a modest beat on the bottom line overall.
Right, that classic situation. Revenue a touch light, but the profit per share, that carries the positive story. Okay. Beyond those main numbers, what were the key performance indicators, the operational things that stood out for Entra this quarter?
Well, what really caught my eye were the significant positive property revaluations. We're talking NOK 289 million. And that alone just propelled their profit before tax up by, get this, 55%. Huge jump. And operationally, their occupancy rate saw a great rebound. It climbed 80 basis points, hitting 94.6%. That's actually their best level in 2 years.
94.6% occupancy. That's definitely something to highlight, especially, given the chatter around office space these days. What else signaled this strong underlying momentum for them?
We also saw their EPRA NRV, that's their net reinstatement value, increase to NOK 166. That's up NOK 3 in just the quarter. And net letting was positive too, at NOK 22 million. Now, cash earnings per share stayed flat at NOK 7.1 over the last 12 months. But their net asset value, the NAV, it ticked up slightly again. That's the fourth quarter in a row.
Okay, fourth quarter of NAV increases.
Yeah, and that consistency, it isn't just a number, right? It tells you their core portfolio, the bedrock of their business, is steadily appreciating, even in this dynamic market.
Right.
It signals real underlying strength beyond just like the rental income swings.
Okay, so a lot of positive signals in those initial numbers, good stuff. But to really get under the hood, understand what's driving this, we need to dig into the core financials. Let's start with rental income. You said it was NOK 770 million, down a bit from NOK 785 million last year. What's the story there?
Yeah, so management mainly pointed to strategic divestments. The big one was the Tron portfolio sale back in Q2 2024. If you actually adjust for all the divestments, and there was a specific lease buyout too, the underlying growth year over year, it shows a healthy 1.2% increase.
Okay, so strip out the sales and it's actually growing.
Exactly. Think of it like pruning a tree maybe. The overall size shrinks for a moment, but the remaining branches are actually growing stronger. There were positive impacts from CPI inflation that added NOK 17 million, and ongoing projects kicked in NOK 11 million, but those were offset a bit by other divestments, about NOK 10 million, and increased vacancy, which had a negative NOK 80 million impact if you ignore the CPI effect.
Right, that underlying growth figure, that's a really crucial detail. It suggests the core business is healthy, even with those portfolio changes. Now, how did this all flow down? Profitability, cost control, how did they manage that side?
Net income from property management was pretty solid. NOK 352 million, that's up from NOK 348 million last year. And actually, it showed a strong 10% improvement just quarter over quarter.
10% quarter over quarter, nice.
Yeah, and that was driven by, effective cost savings and also reduced interest expenses, which we can touch on. Operating expenses, OPEX, were remarkably lean, just NOK 58 million. That's only 7.5% of rental income.
Very low.
Very low. And that reflects both the impact of those divestments. Selling out properties means fewer costs. And also, they mentioned reduced energy consumption. Admin costs were pretty much as expected, NOK 51 million, right in line.
Okay, so operational costs clearly well under control. But, for a business like real estate, it's capital intensive. How they manage their debt, their funding, that's just as vital. What's the picture looking like there? Leverage funding new growth.
Yeah, absolutely critical. And their financial position is definitely strengthened. Net realized financials improved by NOK 68 million compared to last year. Now, this is mainly because they cut their debt level significantly, almost NOK 7 billion reduction.
7 billion. Wow.
Yeah, huge. Directly from those strategic divestments, plus they benefited from a lower average interest rate. Their interest coverage ratio, the ICR, it seems to have bottomed out and actually improved from 1.98 to 2.03.
Okay, ticking up over that 2x mark.
Exactly. And that slight bump, it might seem small, but for a real estate firm, going from 1.98 to 2.03, that could be a critical step. It suggests, a stronger buffer against interest rate moves could lead to better lending terms down the line, more financial flexibility.
Makes sense.
Their leverage ratio held steady at 49.1%, and net debt to gross book value of assets, GBTA, stayed at 11.7%. What's really striking, I think, is their all-in net financial cost is now down to 4.23%.
4.23%. That's pretty good in this environment.
It really is. They've also been active tapping the debt markets, issued NOK 1 billion in new unsecured bonds, reopened for another NOK 700 million. They're benefiting from credit spreads tightening. And importantly, they have plenty of available liquidity, enough for more than the next 24 months, they said.
Okay, that's a strong position. Plenty of cash, cost of debt coming down. So how are they putting their capital to work then? Especially for new projects, with that funding picture in mind.
Well, CapEx in the quarter was NOK 335 million, mostly for projects already underway. The remaining CapEx needed for these current projects is about NOK 640 million. But the company seems very disciplined here. They're prioritizing spending that increases occupancy or helps them realize, rent uplift potential in their existing buildings. They're not really embarking on big speculative new builds right now.
Smart. Focusing on value within what they already own.
Yeah, it signals efficiency, that focus on value creation.
Okay, let's shift gears a bit. What's management actually seeing on the ground? The CEO mentioned robust letting activity. What's the story from their leasing efforts?
Yeah, gross leasing hit NOK 203 million. The CEO specifically highlighted a big deal with Yara. They extended an existing lease for 10 years at Yara's headquarters. Now, that's positive for Entra because, lower CapEx involved when you keep a tenant.
Right. Less costly than finding a new one.
Exactly. But interestingly, this specific deal actually had a negative net letting effect of NOK 24 million for this quarter.
Huh. How does it work?
Because a previously signed deal for Yara to take larger space in a neighboring building means that original space will now become available in Q2 next year. So it affects the forward look. But, and this is the crucial bit, overall net letting for the quarter still remained positive.
Okay. So a specific timing thing with one big deal, but the overall trend was still adding tenants.
Precisely. It shows they can retain key tenants even while managing these portfolio transitions. It's strategic.
Makes sense. Playing the long game. And speaking of tenants staying, occupancy, we saw that nice jump earlier. What's the outlook there? Are they expecting more gains?
Well, occupancy did rise, like we said, 80 basis points to 94.6%. That's good. Management does expect some fluctuations going forward, past lease terminations working through the system, future refurbishment projects, taking space offline temporarily. But they express strong confidence in their ability to let the vacant space over time. And importantly, they said they're doing that while simultaneously chasing market rent uplifts.
Right, not just filling space at any price. They want higher rents too.
Exactly. That's a key distinction. Quality over just quantity.
And their development projects, the refurbishments, are those going to plan? What's the impact?
Yeah, they reported all ongoing projects are on time and within budget. Good news there. The refurbishment of Damasveen 134, that's a big one, 21,000 square meters, is particularly notable. They've already re-signed 66% of the existing tenants there, which is great momentum.
Good sign.
And this project, it aims to boost the energy class from D up to C. And why does that matter? It brings it in line with these strict taxonomy requirements for green financing.
The EU rules for sustainable investment.
Exactly. Meeting those can unlock better loan rates, attract ESG investors, you know the drill. And this specific project is projected to yield around 5.8% on cost. Compare that to prime yields in the area, which are maybe around 5%.
So a healthy spread, creating value there.
Definitely. And other projects too, like Nunhagen and Bergen, saw big occupancy gains, went from 55% filled to 83% just in this quarter.
Okay, so good progress on the project front. That focus on energy class, meeting taxonomy rules, it leads us right into ESG and sustainability. How is Entra positioned there? Is it just a buzzword or part of the strategy?
It seems very much part of the strategy.
Yeah.
And it's a critical point that differentiates them, I think. Entra is actually the first Norwegian company to get its climate targets validated by the Science Based Targets Initiative, SBTI, under the specific framework for the building sector.
Okay, that's a significant stamp of approval.
It really is. And what's truly interesting, kind of counterintuitive maybe, is that their biggest source of emissions isn't energy use. It's actually from material production and transportation for their projects and maintenance.
Not energy. Why is that?
Well, Norway has a largely renewable electricity grid, and Entra's portfolio is already pretty energy efficient. So this means their focus on reducing material consumption using less stuff. Smarter materials aligns directly with cutting costs and boosting profitability.
So sustainability is the business strategy in a way, not just a separate report.
Exactly. It's integrated. It's not just, a CSR initiative off to the side.
That's smart. Really smart. Okay, let's zoom out now. Look at the bigger picture, the investor context. What's the macro environment like in Norway? How does that backdrop affect a company like Entra?
Well, the Norwegian economy generally remains pretty solid, stable, even with all the global volatility we see. There's minimal direct impact from things like, say, U.S. tariffs. And Norway has strong tools, fiscal and monetary policy, plus that huge sovereign wealth fund to provide support if needed.
Right, the oil fund cushion.
Exactly. And here's a key thing for real estate.
Yeah.
The first rate cut from Norges Bank, the central bank, came in June, cut the key rate to 4.25%. And they're signaling potentially up to 2 more cuts this year.
Okay, rate cuts starting. And how are those expected to play out? Stimulate the economy? Help places like Oslo?
Yeah, the anticipation is definitely for stimulation, particularly benefiting the Oslo region. Lower rates plus solid wage growth should feed through. Now, looking specifically at the real estate market dynamics, Q2 letting activity, actual signed deals, was maybe on the lower end of normal. However, lease searches companies looking for space have notably increased through Q1 and Q2.
The pipeline's building.
Exactly. Those searches often take 6 to 12 months to turn into signed leases, so it signals potential for more activity in the second half of the year.
Okay, interesting indicator. What about vacancy rates right now and new supply coming online in Oslo? Any shifts there?
Oslo's overall vacancy is sitting around 6.5%. Expected to maybe tick up slightly towards 7%. But what's important for Entra is where the vacancy is highest. We're seeing higher rates in older buildings. Some pockets of the city are over 8% vacancy in that older stock.
Right.
Most of Entra's own vacancy is in the smaller office segment, like under 2,500 square meters. Competition there is pretty strong because of the sublease market companies trying to offload excess space.
Okay, and new buildings?
New construction is still limited in the short term. That's generally good for existing landlords like Entra. However, there seems to be increased activity planning for larger spaces, which could expand the supply pipeline maybe from 2028, 2029 onwards. Something to watch.
So limited new supply for now keeps things tight, but maybe more coming down the road. What does all this mean for rental growth, especially for the prime properties that Entra focuses on?
Well, the market fundamentals for Oslo's letting market look pretty promising, actually. Rents are generally expected to increase more than inflation in the coming years. The consensus points to something like 11% rental income growth over the next 3 years.
11% over 3 years? That's strong.
It is. And we have fresh data showing that the top 25% segment of Oslo inner-city leases, which is where Entra has most of its portfolio, that segment saw 10% income growth in the first half of 2025 compared to last year.
10% growth in the top tier already this year. That really highlights that flight to quality trend we hear about.
Absolutely. It's very clear. And market rents are also starting to converge towards the break-even points needed for new projects, which is a positive sign for future development viability too.
Okay. And what about buying and selling properties? The transaction market. Is capital flowing? Are deals happening?
Yeah. The transaction market has stayed active, and it's expected to pick up even further in the second half of this year, especially with more rate cuts potentially coming. H1 transaction volumes were around NOK 35 billion. That's pretty much in line with last year. Prime yields for the best properties are holding around 4.5%. And that's been confirmed by recent deals where, interestingly, equity buyers using mostly cash, not debt, have been dominant.
So cash buyers are still paying up for prime assets. It's a good sign for valuations, right? Despite uncertainty?
Absolutely. It speaks volumes about continued investor confidence in those top-tier, well-located, high-quality assets.
Okay, great context. So putting it all together, the results, the market backdrop, what's management's updated guidance? What's their outlook now?
Well, Reflecting this confidence, management actually raised their 2025 rental growth and occupancy targets. That's a strong signal. They expect a continued gradual improvement in their credit metrics, supported by, running cash flow, that capital discipline we talked about, potential value increases from revaluations, and those potential further interest rate cuts.
And they think this could lead to?
They believe this is paving the way for a future credit rating upgrade, which of course would mean even better borrowing terms, lower costs down the line.
Right. Big potential benefit.
Yeah. And the positive net letting they achieved in Q2, it's already having a positive impact on their forecast for 2026 rental income. Plus, there's significant upside potential still untapped. Letting their current vacant space could bring in NOK $188 million per year when completed and leased. And then there's reletting space where leases have been terminated. Lots of levers to pull.
Okay, so a lot of embedded potential still there. All right, let's shift into our This Is Not Financial Advice segment. Quick reminder, everyone, this part is purely conceptual. Think of it like analysts brainstorming, pitching ideas. These are absolutely not recommendations. So here's a thought for you, based on what we've heard. The prime ascent, legacy descent, arbitrage.
Okay, intriguing name. What's the pitch? Lay it out.
Right. So given Entra's proven success in boosting the value of its prime high-quality buildings through smart refurbishments like that Damascene 134 project, yielding 5.8% against maybe a 5% market yield, and seeing that clear split in rent growth between the top-tier offices in Oslo and the, let's say, general or older stock, we propose this conceptual arbitrage trade.
Okay. And how would someone hypothetically structure that? What's the action?
The idea would be to go long Entra ASA. You're betting on their strong prime portfolio, their ability to keep driving up rents and occupancy. Simultaneously, you'd identify and conceptually short a basket of other publicly traded Norwegian real estate firms or REITs, specifically ones that are mostly exposed to that older, smaller office stock, especially those in submarkets facing higher vacancy. You mentioned over 8% in some older areas, and that tough competition from subleasing.
Got it. So the rationale really hinges on that performance gap widening even further between the best and the rest.
Exactly. Entra seems uniquely positioned to benefit from this flight to quality. Plus, they get better funding conditions for their green buildings, and they're proactive about creating value through upgrades.
Right, while the legacy segment.
The legacy segment, conversely, looks likely to face more headwinds. Structural oversupply and smaller units, maybe rising costs to meet ESG standards without being able to charge premium rents for it, potentially less favorable access to capital.
Yeah, it could be tougher for them.
So this conceptual trade basically aims to profit from that widening performance gap between the best-in-class, future-proofed assets like Entra's and the structurally challenged properties that might struggle to keep tenants or maintain rents in a market that's getting more discerning. Okay, so let's try and wrap this up. To sum it all up, Entra's Q2 FY25 results, they really paint a picture of a company capitalizing well on its prime Norwegian office portfolio.
Yeah, they seem to be navigating the market ups and downs pretty effectively. Strategic sales, strong letting, keeping costs in check, disciplined with capital.
Absolutely. And you see those improved financial metrics, the easing funding costs are a big help, and that robust outlook for prime rental growth, all supported by the broader stability in Norway's economy. It really signals continued positive momentum for them, doesn't it?
It certainly seems that way. And just the obligatory reminder, folks, this deep dive, it's purely for informational purposes. It should definitely not be taken as investment advice. Please do your own research.
Absolutely. And here's a final thought to leave you with. As the whole real estate sector faces more and more scrutiny over sustainability, energy efficiency, think about how critical a company's green credentials are becoming. It's not just about attracting tenants and getting better financing anymore. It seems like it's also about unlocking superior long-term asset value, maybe even achieving that rating upgrade Entra mentioned.
That's a great point. How prepared are other REITs, other property companies, to really meet this evolving demand? Or, will some get left behind if they can't keep up?
Something to ponder.
Well, thank you for joining us on this deep dive into Entra's Q2 earnings. We definitely encourage you to continue your own research and analysis.
Yeah, thanks for tuning in. We'll be back soon with another earnings call breakdown.